Good afternoon, and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Connie Hill. She's there to help answer your questions along the way. Be a part of the conversation, if you will. If you're here in the live version, go ahead and add some questions into the discussion and be a part of that conversation. If you're here in the recorded version, we're glad to have you with us as well. By all means, leave a comment in the comment section. We will get back to you as quickly as we can, typically within one day on those comments. So we're going to talk a little bit about index options today. We kind of made a switch in the last couple of weeks to one of our strategies, and we've had a bit of a rip your face off rally yesterday in the broad market indices. We'll see what that has brought about in some of those index option moves. We're going to take a look at what's going on with the volatility index, the VIX, as well as perhaps a longer duration trade, one that we've rolled a couple of times here. So as we get into this, a couple of quick housekeeping items. Remember that everything that we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice or solicitation about a particular security or strategy or account type or anything else. Remember that investing involves risk, including the loss of principal, past performance, no guarantee future results. Now, whenever we talk about equity and index options, just remember this, that they carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Now, the options that we will be looking at in this class today, in this discussion, and likewise in nearly all of the webcasts that we teach in this Trading Index Options series, are European style options. That means that they cannot be exercised until expiration, which removes the possibility of early assignment. However, American style options can be exercised at any time up to and including expiration. Those options do have early assignment risk. So anyone short an American style option could be assigned at any time up to expiration, regardless of whether that option is in the money, at the money, or out of the money. It doesn't matter. Now, as we get to close to expiration, there are some specific risks that need to be considered, and that is potentially dependent upon strategy. Some of those risks include lack of liquidity, slippage, and circumstances where the trade may not be filled, may not be taken, in fact, may be rejected because of that potential risk. So that's something to consider. Also, we're going to be using the Thinkorswim desktop software platform today. It is not a guarantee of future success out there in the real world. It is, however, the paper money version, a great learning environment. That being said, it behaves a little bit differently than a real money environment would behave, namely in the nature of fill prices, but it does not facilitate that early assignment of short options. Now, if we're trading European style options, which we are in this class, not an issue. If you're trading American style options, that is something to be considered, because in a paper money account, it's not going to facilitate that. You're not going to see early assignment. In a live trading account, you can and may, in fact, experience that if you're trading an American style option. So we're going to jump into this discussion here really quickly. We're going to take a look at what's going on in the market as a whole. I'm going to pop over here to our index grid. And welcome to those of you that are here with us for the first time. Welcome to those of you who have been here with us on a number of occasions. I appreciate both groups being here. So we'll spend a little bit of time talking about the reasons why perhaps that we trade index options as opposed to perhaps an American style option or a single stock option. And one of those is the fact that in many cases, traders or investors may build portfolios that may have some concentration into one area or another. Those portfolios might be concentrated into technology or energy or financials or a combination of some of those. Nevertheless, that concentration leads to the potential for when one of them goes down, they all go down, or when one of them goes up, they all go up to varying degrees. So that presents a possible challenge when offsetting some of that potential risk. So a trader who is long a bunch of technology stocks could place stop loss orders on all of those technology stocks, could buy individual protective put options on all of those technology stocks, or to be perhaps a bit more efficient, may use a position in an index option to hedge against that adverse performance in a broader group of stocks that all behave relatively similarly. We'll take a look at that here in just a few minutes. But as we start to look around at what's going on in the market right now, starting to see a little bit of a rally in the SPX over the last couple of days. In fact, I would perhaps this rally that we saw yesterday, now putting us up on the week, a total of about 3.25%, was a pretty strong upward momentum move. Now, that being said, there was a little bit of follow through today. Still is a little bit of follow through today, albeit coming off of those highs just a little bit. We can kind of see that as it approached the 200 period moving average. This is the S&P 500, the broadest cross section of the market, if you will, and starting to see that rally up and a little bit of backing off, a little bit of testing, price discovery right up near that 200 period moving average. Does that mean that it's going to fall? Well, it doesn't. It just doesn't. Just the fact that it's testing at that 200 period moving average does not mean that this was a bull trap or anything else like that. It means that there is perhaps a bit of profit taking over the last couple of days. There is perhaps a bit of a wait and see for some confirmation. If this breaks above the 200 period moving average, that then some of those individual stocks become in play, if you will, and individual investors now start to buy those positions as the overall market regains that 200 period moving average. That being said, given the fact that if we were to put something like an RSI on here, we saw a pretty strong shift in that momentum from downward to upward momentum from that lower reversal zone. And it doesn't mean by any means either that this was just some kind of rebound, that dead cat bounce, as someone pointed out. Could it be? Sure. Does it have to be? Absolutely not. And a break up through this 200 period moving average may in fact be the confirmation that traders in this perspective are looking for. That 200 period moving average oftentimes acting as a relatively strong long-term level of support or resistance. Let's come back over here to the to the NASDAQ. And in the NASDAQ, we see even a little bit more follow through into today's trading off of that big move to the upside. What tells me that perhaps there was a bit more momentum here was where yesterday's trading started, above the midpoint of the previous day. Could be this move to the upside, and now looking for that break above that 200 period moving average. Now, in this particular case, let's look over at the Russell 2000. We've seen the Russell 2000 regain the 200 period moving average, testing at or very near this level of resistance. Once again, that resistance level, an area where perhaps there is still a little bit of selling pressure. So this could turn around and move to the downside. There is no indication one way or the other in this particular case, other than that longer term trend. But if you want to look at the long-term trend, looking at the 200 period moving average, 200 period moving average on the Russell 2000 is still moving higher. The 200 period moving average on the NASDAQ, still moving higher. 200 period moving average on the S&P 500, still moving higher. So longer term trends are still in place. Intermediate term trend is down. So to think that this is ultimately a perma bear scenario, I think is as disingenuous as saying that this is just going to keep rallying forever. I think we're at an inflection point, a potential where this could change direction and move either way from this resistance level. Now that then sets us up for the idea of how does a technically driven index option trader perhaps approach this type of scenario. And I think that's where you have to still look at the idea of where this 200 period moving average is in relationship to the current trading price of the index, where the index sits. It's still below that 200 period moving average, in this case, in the S&P 500. In the NASDAQ, it has regained it in the Russell 2000. But in the S&P 500 and the NASDAQ, still below. So traders looking to perhaps hedge that short-term intermediate term trend may look at selling call spreads here, as opposed to the idea of selling a put spread and being full on, risk on, abjectly bullish in this case. So from that standpoint, that's kind of the balance point that we are at, that inflection point. Could it go higher? Yes. Could it go lower from here? Yeah, it could too. But until it gives us clear evidence of one or the other, we have to look at what currently exists. All right, let's take a look at one other index here, and that is the VIX. So we'll take a look at our VIX grid really quickly. And here is the VIX in and of itself. This is the 30-day VIX. This is the traditional view of the VIX. We see that the volatility index over the last 2 days has dropped significantly out of that 30 handle back down into the 24, into the high 24 handle. And it seems to be coming down right about to its average. Now, remember, the VIX in and of itself is not a tradable instrument. The VIX futures are tradable. Options on the VIX are tradable. But the VIX in and of itself is not a tradable instrument. So at this particular point, the VIX is sitting right on its average, right back down to where it has been finding a floor, albeit that floor has been rising a little bit. What does that import then for index options? Well, in and of itself, it tells us that index options, at least index options on the SPX, are becoming cheaper. That risk premium, or that fear premium, if you will, has been bleeding off a little bit. That's the function of the VIX. The VIX is a measurement of implied volatility across an average of S&P 500 or SPX index options. And it functions, it spikes, it moves based on what market participants are willing to pay for those options. So when there is fear afoot in the market, and market participants, institutional investors, large retail traders, are willing to pay more for primarily protective puts, but also works on a speculative basis, protective puts or long calls, either way, those index options become more expensive because there are more buyers, and then the sellers of those options raise the prices via the market makers. When those prices get really high or higher than they have been, then sellers come in and they start to sell those options, and that drives the price back down. That mechanism tends to happen pretty quickly. That supply and demand mechanism tends to happen pretty quickly. So that's kind of what we've seen in the last couple of days, is that volatility bleeding itself off here from this touch right about that 30 level. And if we were to put this out on a longer term chart, I did this a couple of days ago in a webcast, but if you put this out on a 30-day chart, or excuse me, a 3-year weekly chart, you can see that the number of times that 28 to 30 level, I'll even come up to 30, the number of times that 30 level has been touched and then retreated from in the last 5 years, once, twice, 3 times, 4 times, 5 times, 6 times. And every time that we've gotten these big extreme shocks that's gone well beyond that 30 handle, we've seen a fairly quick retracement of VIX as that volatility is bled on. Simple reason, high volatility doesn't tend to last. It's a bit like a snowflake. It melts very quickly, simply because of the nature of supply and demand. So we're seeing volatility bleed off here a little bit. That's beneficial to short options traders. It's working against long option traders because it's taking away from that value of a long option, that Vega component. I spent a little bit of time yesterday in Rachel Deschelle's long options webcast talking about that exact idea of how do you balance theta decay versus Vega sensitivity. So if you have questions about that, that's a good opportunity to take a look at that. All right, so here's what we've got now. We've got volatility bleeding off. I'm going to put this back on a one-year daily chart. We've got the market moving higher, yet not penetrating the 200-period moving average. So that still puts us in kind of that bullish, sort of, but still maybe trading that intermediate term trend when it comes to things like our 14-7 strategy. So here's what we're going to do. I'm going to go over here to the monitor tab, and we're going to take a look at what's going on and what's been going on. So we've got our SPX strategy. Now, for those of you that are brand new to this webcast, let me explain. What we've been doing for the last year and a half is making a decision. Are we bullish or bearish? Intermediate term. And then selling a call spread or selling a put spread, depending on which side, above or below, the SPX currently is relative to the 200-period moving average. If the SPX is above the 200-period moving average, we sell put spreads. If the SPX is below the 200-period moving average, we sell call spreads. So right now, the SPX is still below the 200-period moving average. We're still in the mode of selling puts or selling call spreads. So we sell that call spread on Wednesday, because that's when I teach this webcast, on Wednesday, and we sell an option expiry that is 14 days to go until that expiration date. And then we buy it back the next Wednesday, come what may. That's been the strategy. Are there countless ways that traders could riff on this strategy? Absolutely. This is simply establishing the core structure of this strategy. So here's what we did last week. We sold the 69.10 call, and we bought the 69.30 call, creating a short call vertical spread, which is a bearish biased trade, bearish to neutrally biased trade. We sold that for $1.20. That was based on a 1 standard deviation move and out to about the 17-cent delta. So that 69.10 short call had a very low directional sensitivity, but also had kind of an accelerating theta sensitivity and a declining Vega sensitivity. But what's happened here is that even though the market has gone up, and this is the nature of this trade, that delta sensitivity, that net delta sensitivity of the trade, the net directional sensitivity of the trade, was less than the net Vega sensitivity of the trade, which meant that the move down in implied volatility was much more significant than the move up in the index. So this trade has done exactly what was expected for it to do in this particular case, because we sold the spread, which is a $20 wide spread, sold the spread for $1.20, which meant that at the outset of the trade, we had a fairly high potential theoretical maximum risk. $20 minus 120 gives you that theoretical risk, a little over $17. So here's the thought. Why don't just let it go? Let's just let this expire worthless. Why buy this back at 7 days? Why sacrifice now what's remaining, that nickel? Why pay a nickel to buy this back when it's very likely going to be out of the money at expiration and just going to expire worthless? Because what if it isn't? That's the challenge. So we sell at 14, buy it back at 7, and that's what we're doing here. So the trade that we sold for $1.20 is now trading for a nickel, and I'll buy that back for a nickel in this particular case by right-clicking and creating a closing order. And we got the majority of the trade, the majority of the gain that we could make in this particular trade. In fact, we're keeping in this example trade, because remember, again, this is simply an illustrative example. We're keeping in this trade theoretically $1.15 of the $1.20 that we brought in to begin with. And we're going to go ahead and click on confirm and send. And we're going to fire this order off, and we're going to close this trade down. Now, could we just simply create a rolling order? Yes, that'd be great. And in practical application, that's very likely what I would do. But that doesn't give me the opportunity to illustrate how we're going to put this strategy together. So let's go back to our charts again for a minute. And I'm going to change this chart grid to our index options grid, showing the SPX. And so the left-hand side is our 1-year daily chart. Right-hand side, yep, I'm going to put a couple of new trades on here today, Charles. So, yep, we're going to do another one. So the right-hand side is a 3-month daily so that we can see that. But notice where the SPX is. I'm just going to zoom in so you can see it. Blue line is the 200-period moving average. SPX is just below the 200-period moving average. So we're still, and we're being intellectually honest here, still below the 200-period moving average. So I'm still going to sell a call spread. Is there the possibility this could break through? Yes, absolutely. So volatility did affect that theta, the Vega value, right? Volatility didn't change theta very much. Volatility is not going to change the rate of time decay, but we'll talk through the trade here as we get into this. So what I'm going to do is I'm going to go to the trade tab for SPX, and I'm going to see the date that is my 14-day to go until expiration. So here's my 15 April expiration. That's the time frame. So we're going to go out to the chart. I'm going to move my time hack out, and we'll walk through this trade with its net Greeks to kind of see how this works. So I'm going to do this. Activate the drawing. We're going to take this out to the 15th. There it is right there. Whoops. Nope, I moved it back too far. Activate. 15th, right there. And we'll make that the 15th. We can also do that precisely by just doing this. And click on OK. There it is right there on the 15th. There's the 15th. There's our time hack. Now what we're going to do, this purple line is our probability of expiring cone. And I've added that. Let me just come over to the right-hand side. And we'll maximize that cell. I've added that as a study. Probability of expiring cone. And this is at 1 standard deviation by default. Okay. So we're going to use 1 standard deviation. Now, 1 standard deviation statistically is going to change based on implied volatility. Where the width of this cone is and where it intersects that line depends on volatility. So what we're going to do is I'm going to draw my time hack, the crossover of my time hack right here. So 68.95 is where that line is intersecting with that expiration date. That's going to be our short strike. We're selling at the 1 standard deviation level. Now, could we sell a little bit further out? Yes. Could we sell a little bit closer in? Yes. But this is how I'm building this consistency of this trade. You can see this is the last one that we sold. You can see where this one is. It's a little bit inside, and that's because implied volatility has decreased, even though the market has gone up. So what we're going to do is we're now going to go to the trade tab. We know that our level right there is 68.95. So we're going to go to the monitor tab. I'm sorry, go to the trade tab. We're going to add a few strikes here. We're going to have to add 120 strikes so that we can get to that level. And we're going to go to the call side of the equation. We're in the 15 April expiration. I'm showing delta, gamma, theta, vega. So we're going to go to the 68. I forgot it again already. 68.90. All right, 68, or is it 68.95? 68.95. Go back to the trade tab. 68.95. So we're going to come down here to 68.95. And I don't have a 68.95. I have a 6,900. I have a 68.75. So part of the problem is with selling call spreads, when we get up to this level, we may, now we think about where the granularity of this is, we're losing some granularity in these strike prices. Whereas on the put side, because these trades, these options are used much more often, I think, as opposed to the call side, somewhat more often as hedging positions, as protective instruments. There seems to be a little bit more granularity on the far out of the money put options. Okay. So, Chris, this is once again where delta seems to be a little bit too low. Shouldn't it be around the 16-cent delta? We're on the call side, right? So on the call side, there hasn't been as much speculative upward pressure. So there's just not as much going on over here on the call side. There's not as much demand for these options. So let's come back over here and let's see where that is. That's at 68.90. So I could go to the 6,900 and let's see where the 6,900 level is on the trade tab. This is one of the things that we have to contend with in terms of making that flip-flop and from being selling below or selling above. So one of those considerations. So yeah, going out to the 6,900, we're bringing in $3.30. It's a nickel of delta here, right? And not a lot of delta. So maybe we go the other direction. We go to the 68.75, bringing in a little bit more premium. That bid-ask spread still relatively the same. We're coming in and we're bringing in a little bit more premium. So 68.75. So coming in a little bit inside of where that one standard deviation line is. So we got a little bit of latitude there. That's not a bright line necessarily on the chart. Now we could, again, if this were the rule, we could go to about the 16 or 17 cent delta because we know that's about where it's likely to fall, at least when we're over on the put side. But what's happened is we've had this big collapse in implied volatility. And so that's kind of brought these premiums down. It's brought the deltas down. One of these days, we'll talk a little bit about the option Greek called charm, which is how deltas change relative to where we are in the expiration cycle. So we'll talk about that and where we are relative to in the money or at the money or out of the money. Maybe we'll do that next week. Maybe next week we will go to charm school. How about that? All right, so I'm going to go to the 68.75 and we're going to look at selling the 68.75 and then we're going to go 20 points wide. If we can go 25 points wide to this one, to the 68, to the 6,900. So this is going a little bit wider than we have been going. So let's do this. Let's see what we get out of that. $1.80. It's 25 points wide. So we click on confirm and send. That means our max theoretical loss is going to be larger, but we deal with what we deal with and we go with what we've got. I know we've been keeping those to 20-point wide spreads, but in this particular case, we don't have a 20-point wide spread. So we got to deal with what we've got available to us. So we come back here. We're going to put this in our index options weekly group. And let's kind of take a look at this here really quickly. Before we send this order off, I want to talk about these net Greeks. We're selling the 68.75 and we're buying the 68 or the 6,900. So let's just kind of do the back of the napkin math here. We're left with about 2 cents of directional sensitivity, not very sensitive to directional movement at all, which is beneficial for us if we get a rally to the upside, right? If we get a rally to the upside. We've got a 0 net gamma still, because gamma becomes more significant the closer we get to expiration. Our net theta in this particular case, let's just use our calculator here so that we don't get this wrong. We'll switch our gadget here. We'll say, all right, so 68.75 has 84 cent theta minus the positive 62 cents theta. We're left with 22 cents of theta. So every day that passes, losing 22 cents out of that premium, which is exactly what we want it to do. Now let's look at our net Vega sensitivity. So 68.75 has $1.66 per percent of implied volatility of Vega sensitivity, and we subtract from that 1.28, we are left with 38 cents of volatility sensitivity. So here's what we've got. We've got a trade that's got 2 cents of directional sensitivity, not very directionally sensitive at all. We've got a trade that has no gamma sensitivity, at least now, at this point. We have a trade that has 22 cents of theta sensitivity or time decay sensitivity. So the passage of time is working in our favor here. But the Vega sensitivity, the volatility sensitivity of this trade is a net 38 cents. So if implied volatility goes down, that is working in our favor more than anything else. So this becomes a volatility trade. So if volatility has started to go down and may continue to go down, that could work in our favor more than the trade going against us, right? Now, in this particular case, if we run into this situation, if price starts to move up, these are all going to change. That's the thing. These are never static. If one of these is changing, so are the others. So if implied volatility expands, if the VIX goes up, that means that could work against us pretty quickly. That would be the damaging factor here in terms of those net Greeks. Now, Dagan Viking asks the question, when would gamma start increasing? Let's take a look real quick. Before we click this trade off, let's see when we start to see a gamma increase out at those strike prices. So let's come back into about 9 days to go until expiration. We'll scroll way back down here. Not even at 9 days do we really start to see a gamma increase. Because if anything, we're going to start to see gamma occurring, that gamma influence occurring right about the at-the-money option. So if we come down here to 5 days to go until expiration, let's see if we get any kind of gamma bump right here in the middle. And we're just not. I mean, there's just not a lot of influence of gamma until we get down to 1 or 2 days to go until expiration. And even then, if we get down to 0 DTE, that's when gamma really starts to accelerate. And I'm not seeing gamma. There we go. Now we're starting to see, we get down to 1 or 2 days prior to expiration, we're seeing a little bit of influence from gamma. Gamma becomes much more significant the closer we get to expiration, especially on an index option that has lots of strikes, right? So option 66 is, where's the $1.22 coming, or the $1.28 coming from? So let's go back to our 14 days to go until expiration. And let's come right back down here. We were selling the 67 or the 68.75 and buying the 68.90. So we've got a $1.66 of Vega in the 68.75, and we've got a $1.28 of Vega in the 6,900, right? In this trade, again, Vega is the one that we should worry the most about because that's the one that has the greatest impact here. We're now down because these have moved a little bit to 1 penny of directional sensitivity, still about 21 cents of time decay of theta sensitivity, and that, what did we say, 38 cents of Vega sensitivity that's remaining here? So the main Greek that we're worried about is implied volatility. So if volatility goes down, now if we get a big ramp up in volatility, this could work against us pretty quickly. But that's how we kind of go about determining what's the biggest factor here. So I'm going to go ahead and we're going to click on confirm and send. I'm going to see if we can work this up a little bit to nickel over the bid. We'll see if we can get that, or the midpoint. Let's see if we can get that. Confirm and send. We're going to make sure that we put this in our index options weekly group. We'll click on send and we'll see if we can fire that order off. There may not be much liquidity way out here on the call side. We'll see. We might have to wait a little bit for this trade to fill. So there you go. That's where we're currently sitting. All right. We'll see if we need to bump that a little bit. We'll let that kind of cook and work and see if we can get into that trade. I'm going to come back over here, and the one that I was going to look at really quickly is putting on a hedging trade on technology. So I'm going to come back to restore those cells. And what I want to do here in this particular case is I want to go to my monitor tab again for just a second. I've got a group of stocks in this particular case. I've got Netflix, and I've got Microsoft, and I've got Avigo, and I've got Amazon. So some that are fairly sensitive um, to the technology sector. The reason I'm looking at this, and the reason I kind of have this segment of my portfolio set up, is that individually these trades, these positions have about 2,717 net deltas. Oh, we just sold it for $1.80. That's cool. I like that. In and of themselves. And if I were to manage each one of these by buying puts or putting stops, that's going to be time inefficient. It's also going to be challenging cost wise. So what I'm going to do is I'm going to beta weight this portion of the portfolio, and I'm going to beta weight it to the NDX index. So now what I've done is I've adjusted all of those individual deltas to NDX or NASDAQ deltas. So the equivalent of that is this portfolio is sensitive to the NASDAQ to the tune of about 26 deltas. It's got about 26 deltas of exposure. Well, what does that mean? That means that if the NASDAQ goes up $1, I'm gaining about theoretically $26 in my portfolio. If the NASDAQ goes down $1, I'm losing about $26 in my portfolio. So how do I take some of that sensitivity out? Well, that's where I go over to the trade tab once again. Now, before I do that, I'm going to jump back over here to the NASDAQ, NDX, and I'm going to say this. So Charles is asking the question, a couple of people are asking the question, what do we look for to manage that call spread that we just placed? We buy it back at 7 days. We're not putting a stop on it. We're not taking it off at a particular price. We're simply buying it back at 7 days, come what may. Simply from the standpoint of saying you can manage it how you want to, and there are ways to manage it. You could put a stop. You could put a profit target on that to take it off when it's done 80% of the work, something like that. We're not going to in this case. All right, so what we're going to do in this particular case is I'm going to buy some protection for this portion of my portfolio out for the next couple of weeks as we start to get into earnings season. That's going to create a little bit of volatility, may create some of the volatility in some of these technology names that are going to start reporting. So I'm going to go out in this case about 20 days to go until expiration. And I'm going to look at buying a put option. Now, Delta in this particular case is going to be the factor that I'm going to be looking at, because that's going to tell me how much exposure I'm going to take out of that portfolio by buying one contract of that portfolio, of that put option, or creating a put spread, for instance, to offset, if you will, that mix. So we can do this. It's going to be relatively expensive. So let's start there. We could come down and we could just make this completely delta neutral and not have any upside, which we maybe don't want to do. So I'm going to switch that, because if I were to buy one put option at the 23,100 strike, that's going to remove 25 deltas, NASDAQ deltas, from my portfolio. That's going to make it roughly delta neutral. But in this case, what I'm going to do is I'm going to leave some deltas in there. I want a little bit of exposure. I don't want a lot of exposure. So I'm going to maybe let's take off about half of that 25 deltas. Let's take off 13 deltas. So I could come down here and I could buy the 22,200 strike price. I'm going to remove 13 deltas, which means that I'm going to leave about 12 deltas in place, both to the upside and to the downside. I want a little bit of upside sensitivity still. And it's going to cost me about half of what removing all of those 25 deltas was going to cost me. So let's just do this really quickly. I'm going to left click. We're going to buy this put option. It's going to be expensive. It's an $11,000 hedge, and we don't expect to make money on it. But if we've got a significant portfolio like that one is, this purchase of an offsetting risk instrument to reduce that sensitivity may be a protective instrument over a particular period of time. So I just want to demonstrate this, and then we'll take a look at maybe another way that we could do this. So what I'm going to do now is I'm going to come down and put this in my beta weighting group. and I'm going to click on send, and we're going to fire that order off. And we've now reduced the number of deltas in that portion of our portfolio to about 14 deltas. I was a little bit high. So we reduced that by about 14 deltas. Now, there's another way that we could do that. I'm going to come back here to my NDX. I'm going to move that to a different group. I'm going to move that to my index options, the one that we just bought. Now we're back to 26 deltas. We could go back to our trade tab, and we could create a vertical spread that's also going to create negative deltas, because we want to take out of that equation some of those long deltas. So how could we create negative deltas? We could buy a put spread, but that's going to be expensive. We could sell a call spread, and that's going to be perhaps a little bit more efficient, especially if our expectation is downside possible movement. So what we could do is we could say, all right, let's take an option. Let's say this 24,900 that has 24 deltas, and we'll sell that one. And then at the same time, we'll come back in and we'll buy one that has about 12 deltas, the 25,300. Now we're getting a little bit of a credit. We're bringing in some premium, so we're getting paid for this. But the net delta there was about negative 14 deltas. So what we can do is we can come in and click on confirm and send, and we'll send this. Now, max theoretical loss is pretty substantial here. But again, we're going to not hold on to this all the way till expiration. And the way that we would get hit is a big rip your face off rally, in which case we'd look at unwinding this hedge and letting the portfolio move. So now we're going to put this up in the beta waiting group, and we're going to send this off. And now we sold that vertical spread. And let's see what we did to reduce our thetas. So we go to our monitor tab, and now that net minus 12 deltas for that vertical spread that we just sold is now reducing the amount of deltas sensitivity that we have in this portfolio, and we're getting paid for it. So 6 of one, half a dozen of the other, sort of. One's costing us a lot. One is we're bringing some premium in, but now you got to think about what that potential loss is. So hedging isn't without a cost. Hedging isn't intended to make a profit, but hedging is there to protect in this type of scenario. So all we did is we beta weighted our portfolio. If that instrument doesn't work, we could use another instrument. We could beta weight to a different instrument. So that's what we've done today. We put in and managed our 14.7 trade, and we put on a couple of different examples of how we might beta weight our portfolio and hedge using delta as the hedging factor. So that being said, if you want to learn a little bit more about these strategies or ideas, there's some great resources that you can go to right here. Type in hedge, and this is on the Trader Talks webcast page. And you've got a bunch of different webcasts talking about, in fact, there's Connie talking about hedges, and a few from James Boyd and me and a few other people. And when you're here, give us a quick follow on that subscribe button if you haven't done so already. Also, come on over here and you can see the schedule for our in-person events and our live webcasts as well. My thanks to Connie Hill for helping out. Guys, have a great day. Remember, it's a holiday shortened week. Friday is Good Friday. The markets will be closed and our webcast will be dark, as will other educational services here at Schwab. So thanks for joining us. We will see you again soon. Take care, everybody. Bye-bye.